All right. So I don't play golf. This is a beautiful place to do so, of course. Those of you who know me or who've heard about my short-lived passion for golf will know that pointing is probably the best use of this tool. I also don't do laser pointers past my third coffee, so I'm going to try to use this for a last time today, and then maybe retire it. So I want to be on the somewhat more abstract side of the same topic and talk about data in general. So less about alpha and strategies and more about just how do you learn from data and how much data do we actually have to ultimately shed light on the question of why has AI not yet revolutionized quant investing? And I'm going to be a little bit more controversial, I guess, and argue it hasn't. I'm sure that there are pockets in quant investing where these tools have been very successful. But I want to highlight generally why you might want to be skeptical about these tools given the data that we have, and particularly how little data we have, as I'll argue. I guess I should also qualify that probably this presentation will at some point be dated, because as data goes, we're going to collect more and more over time. So it's maybe just a question of how long will it be until AI is going to revolutionize basically every part of our life, including quant investing, but I think we're going to see we're still a ways ahead. So, some disclaimers. With certainty, there are going to be more and more of those every year. So AI has had its ups and downs, and some of the successes have been amazing. So here's kind of the leading success story, and that's playing games. So DeepMind, which is known as AlphaZero, or has been rebranded as AlphaZero, is a reinforced deep learning network that is unsupervised. It learns from itself, and within a matter of an hour or two, it can beat any master at the games of Go and chess. And it does it by self-play. So it just keeps playing itself, and the only inputs are basically the rules of the game. And as it learns about the successful strategies and probability spaces, it ultimately perfects the game. And 9 to 12 hours, it says. And it sort of is a master at it. It does that with a pretty impressive technology budget, but nevertheless, a little bit less money, a little bit more time probably gets you to the same outcome. Here's another fairly impressive application. If you thought this was my prop, actually my Apple Watch is my prop. On this Apple Watch, there is a deep learning algorithm that constantly measures my heartbeat and tries to detect heart arrhythmia. It's an algorithm called Deep Heart. It's semi-supervised, which means that the data it was fed are cardiograms, some of which were labeled as healthy versus unhealthy, many of which were unlabeled, and it has learned to predict heart arrhythmia at the same success rate as what your physician can do when you go for your annual checkup, except it does it several times an hour, or maybe even several times a minute. So great automation provided from a deep learning tool. And then here is the more challenging part that Chris alluded to. I labeled this deep money because in this literature, as you read it, everything has to have a cute name. But this is an ETF, AIEQ. It's run on Watson's supercomputer. It uses structured and unstructured data. It's a deep neural net, semi-supervised, and it is struggling, or has been struggling, to keep up with this benchmark, which is the S&P index. So you see in blue the performance of this deep money algorithm, and in yellow the performance of the S&P over that same sample period. So the broad question is, really what I want to think about is, how are these two different? Applications in medicine versus applications in investments. I don't want to really talk about the games. The games are cute, but because the rules are known, the games are kind of cheating. Because in the real world applications, you very rarely have a self-playing aspect of the data. If we did, we would have to write down models of how data is generated and then let the computer play with those models, but that's tricky. So I want to think about more about database learning, which gets me into the realm of medicine and then ultimately investing. And the question is, why can the computer read one of these charts and not the other? So on the left is a cardiogram, and somebody, a physician, has scribbled into it the various markers that you have to pay attention to in order to make a diagnosis of heart arrhythmia. And on the right is the chartist picture of the S&P, and it looks, not much different. It just has a whole bunch of things scribbled into it, and in one case, we can come up with an algorithm that with 97% accuracy replicates what the physician would say, and in the other, we might struggle to determine whether the market is going to go up or down the next day. So what's different about these two pictures? The skeptic in the room is going to find the answer extremely obvious. It's obvious. On the left-hand side, we have a physical phenomenon, and physical phenomenons can be modeled, and ultimately the physical forces that act in the heart can be uncovered. Whereas on the right-hand side, we have an interaction of individuals. We got traders trading with one another, and they're using different strategies, different models at different times. So this data is constantly changing. So how can you learn about it with any sort of precision? Because you're always chasing a moving target. A more subtle answer I want to discuss very briefly before we get into data is, maybe the success criteria is different. Maybe what I call a success on my Apple Watch is different than what you would call a success with your manager that's deploying the same algorithm, and I'll get into what I mean by that in just a second. But the main part of what I want to talk about is the quality of the data that is being used to train these different algorithms, and directly with quality interacts the question of quantity. Because the lower the quality of the data, the higher the quantity of the data that we have to use in order to end up with the same amount of information. That's basic statistics. So the remaining part of my talk is going to get into these three issues, and then hopefully I'll have a little bit of time to talk about what I think might be some possible approaches once you see or agree that there's a problem. So what constitutes success for an algorithm? Here's the Apple Watch algorithm. It's an algorithm developed by very smart computer scientists at Stanford, 35-layer neural network. So just for those of you not familiar with this literature, we're basically in the third generation of AI. The first generation was when computers were first invented, and people thought neural nets would ultimately, not neural nets back then, sort of your traditional machine learning tools would ultimately revolutionize the world. The second generation looked at neural nets, but then computing power wasn't quite what it was yet, and so those neural nets were sort of single-layer neural nets that didn't get you at the same interactions and detectability that modern algorithms have. We're in the deep learning phase of AI, and so all of the applications I will talk about are deep learning applications of machine learning or AI. This is one of them, multi-layer neural networks. So this is a 35-layer neural network. Again, semi-supervised, so there's some human input in terms of labeling what's a good or a bad outcome, but lots of data. 100 million or so samples, because every time there's a sample being taken, if I check the right box on my app, on my wrist, that cardiogram gets sent to them and gets added to the data set. And that obviously then continuously adds data from 10,000 individuals, so truly independent samples from 10,000 people. So how does it do? It correctly identifies 97% of physicians' diagnoses of arrhythmia, so it's extremely accurate. But then you think about it from an investor's perspective, is that really what you care about or what matters? Because if you think about it, I had to look this up, your annual average mortality rate is about 0.8%. If the doctor tells you you have heart arrhythmia, your annual average mortality rate goes up. It's a tough diagnosis. Goes up to 0.9%. So from the kind of thinking that we think about, risk-adjusted and performance improvement, this algorithm has a 0.1 IC, information coefficient, or Sharpe ratio, risk-adjusted, or baseline adjusted in this case. That's the difference between predicting outcomes versus predicting diagnoses. We can all agree on the diagnosis, but the outcome is still random. And when we judge a manager by how well, or you judge a manager by how well the AI algorithm actually performs in the noisy realizations of data, you're judging them by their outcome, or by how well they predicted the outcome, whereas they might have done a really good job actually predicting something else. So Here's a more concrete example. Suppose I develop an algorithm that I call Deep Analyst, and I haven't done this, but maybe it's a good idea to do one day. In that algorithm, a deep neural net that uses lots and lots of data, somehow, let's assume, manages to predict 97% of analysts' buy-sell recommendations correctly. Is that a success? Is that good or is that bad? So the answer, I would argue, depends on how you're going to use this algorithm. On one hand, it's absolutely impressive because it's automating something that otherwise would be very laborious. And so you take that, you take that algorithm and you can replace tens of thousands of research analysts on Wall Street with it. That's going to be cost savings and really revolutionize the way that banking is done. But on the other hand, from an investment's perspective, it's useless because when I look at the data and I try to see whether analyst recommendations have alpha, they don't. And so what good does it do that I can replicate their opinions, their diagnoses, if the outcome is still the same, that I'm not making money with it? And so I'd argue that most of finance actually cares about the red part of that slide, again, predicting outcomes, and that's what we're really struggling with, not so much the diagnosis part. So let's talk about how we do that, and particularly let's talk about data. So I want to start out with the basic question of how good is our data? And the answer is it's shockingly bad. And I want to convince you of how bad it is and illustrate graphically to you how horrible our data is. And it's horrible because it has an extremely low signal-to-noise ratio. And we always say that. I know I say that to investors all the time, but I thought maybe I can illustrate a little bit better what that means. So let's start with an example, and this goes back to what Josh talked about. If you want to have a double-digit alpha, as he said, let's say a Sharpe ratio of 1, I would argue you probably have to have some breadth in your strategies. So let's say we have 10 independent strategies, 10 independent markets, think of that however you want. The basic math of Sharpe ratios is that if you have 10 return streams that each have a Sharpe ratio of 0.3, they combine into and they're uncorrelated with each other, they combine into a strategy with a Sharpe ratio of 1. So those are the building blocks, 0.3 Sharpe ratio return streams. I'm going to take 0.3 Sharpe ratio return streams, analyze, scale them to 15% volatility, that doesn't matter. I'm going to sample those return streams annually, quarterly, monthly, weekly, or daily. They're 0.3 Sharpe, and these are the moments that I would expect from that return stream sampled at different frequencies. So if I were to sample a 0.3 Sharpe return stream annually, I get a average return of roughly 5% with a 15% volatility. That's your 0.3 Sharpe. If I sample that same return stream monthly, in the third row, I get a return of 40 basis points with a 4% volatility. The ratio of those two numbers, the return I expect relative to the volatility of that return, is the signal-to-noise ratio. And what you see is that the more frequently I sample, the more noisy returns become, and the lower the signal-to-noise ratio is. We go from a signal-to-noise ratio of 0.3 to a signal-to-noise ratio of 0.02. At that point, it's easier to call it the noise-to-signal ratio. So we go from a noise-to-signal ratio of 3 to a noise-to-signal ratio of 50. But those are numbers. What does that actually mean in the data? So a lot of these algorithms come to us from image recognition. And one of the coolest places, most useful application is in autonomous car designs. What we have here is a picture from a car camera that sits by your rearview mirror. And what the computer has to do instantaneously is identify the lane, that's the green, the boundaries of the lane, that's the white and the yellow line next to it, and then other objects that are potential of danger. So that's the black car and the white car, and this algorithm does it very well. And pieces of this technology are in most of our modern cars. Now note, this is a diagnosis-based algorithm still. This is not an outcomes-based algorithm. This algorithm does not predict how likely is it that that black car is going to swear over into my lane and I'm going to have an accident. Right? That's the asset manager analogy. This algorithm only says, can I identify these objects as well as a human being can? So that's kind of the diagnosis part of it. So I'm going to take this picture, and I'm going to add some noise to it. So here's a picture, same picture, with a signal to noise ratio of 10. What that means is that to every valid pixel in this chart, I've added one noisy pixel. Every 10, I added one noisy pixel. So the ratio of good data to bad data is 10 to 1. 5. Good data, every 5 good data points, there's one bad data point. 1. This is the critical threshold in this literature. Now I have as much noise as I have data in my picture. At this point, various algorithms that try to smooth the noise out by, let's say, taking adjacent pixels and combining them and filling in the noisy one with a made-up color, they fail. Because you're as likely to combine two noisy pixels as you are two valid pixels. So machine learners say this is kind of impossible data to start working with. This is a signal-to-noise ratio of 1. Here's a noise-to-signal ratio, I flipped it, of 3. This is what we deal with in annual data. Here's quarterly data. You see where this is going. This is monthly data. This is weekly data. This is a noise-to-signal ratio of 23, which means for every 23 noise points, I get one valid data point in this picture. And the question is, would you really expect that the same algorithm that was designed to make sense and identify things on the left-hand picture, the perfect one, would also be successful at identifying things in the right-hand picture, which is the noisy data that we're dealing with in finance. Luckily, we know how to deal with data when it's noisy, because all we need to do is take multiple snapshots of that same picture, and if we assume that the noise is independent over time across these different snapshots, we can average the noise out. It's just a question of how many pictures do you have to take and then average out over in order to get rid of the noise and have the picture re-emerge. So how much data does one need to average over in order to accomplish this? Same example, 0.3 sharp return streams, sampled at different frequencies, and the simple question is, how much data do I need such that when I average multiple pictures together, I recover a signal-to-noise ratio of 1, that critical threshold beyond which I'm dealing with more noise than I have actual information in my data. And the answer is, I need 10 years of data in this example. I need 10 years of data, interestingly, irregardless of the frequency at which I'm sampling it. This is a lesson from statistics. If I want to learn about average returns from data, I care about the endpoints and how far those two endpoints are apart from one another. I don't care about how much I sampled that path along getting from point A to point B. That's in stark contrast to if I want to learn about volatility, for example. Merton showed us that we want to sample as quickly as possible because the more we sample, the more data we have. Not true for mean returns. So how much data do we actually have? Seemingly a lot. But it's often an illusion. So this is different data than what Josh talked about. I want to show you 3 sort of classic, I guess, macro time series. On the left-hand side is the Shiller Cape of the S&P 500 index from 1986-ish to today. In the middle picture is US 10-year interest rates over that same time period. And in the right picture is one of our nowcasted GDP series. This is GDP data that's augmented with a whole bunch of other macro data in order to make it more continuously updating time series. 33 years of data, 365, 96 observations. And so if this was truly independent data through time, we'd be golden. We'd be in a signal-to-noise ratio of 3 territory. Because we could sample out all the noise. But in fact, this data is not independent at all. It's highly autocorrelated. The autocorrelations in these series are in the 0.8 to 0.9 range. And if you really think about it, and this is where I need my prop, if you really think about how many cycles you have in this data, this is the most obvious. You got like a half a cycle. And you're missing the whole other part of the cycle. And if you started sampling in the 40s, you would have seen the rise in interest rates to the 60s and 70s, and then the subsequent drop of it to fill in a full cycle. Here, I don't know, maybe 2 cycles, maybe 2.5 or 3 cycles, 3 recessions. That's not a lot of observations of something that we might actually care about in these data series. So let me ask then, what is the effect of autocorrelation on how much data I actually have? This is still early in the morning, so I figured we can do a little bit of math. Quick review from statistics. If you had a sample mean of t uncorrelated independent observations, the variability of that sample mean will be 1 over t times the variability of the data. This is how we go from a noise to signal ratio of 23 to a signal to noise ratio of 1. We take enough data observations, make t big enough, 10 years, and the noise will go away over time. Unfortunately, when the data is independent, that formula doesn't work anymore. And intuitively, what happens is we have less data than we originally thought to diversify. Meaning, if I take 2 of these pictures and they have identically bad pixels repeatedly after repeat after repeat, I'm not going to average out that bad pixel by averaging over multiple pictures. It doesn't work. That's because there's autocorrelation in the actual errors, in the actual noise component. So we can actually answer that question. What is the variability of the sample mean relative to what we typically think of, which is that diversification effect, if there's autocorrelation in the data, and that square term in red tells you what the appropriate correction is. What's critical here is this correlation coefficient, which is the correlation between 2 data points L periods apart from one another. It's the Lth order autocorrelation in the data. What you notice with that red term is if the data is uncorrelated, it goes away. And we get the classic result back, that the variability of the sample mean is 1 over t times the variability of the data. If in that term the correlation is equal to 1, it converges to t. And what you learn is the variability of the sample mean, however much you average over data, is always the same as what you started with, the variability of the first data point. Because basically what you have is just repeats of the same noisy data observations that don't go away. Now, given that little bit of math, I can define something, which is this t here, which I will refer to as the effective sample size. It's a hypothetical thought experiment of, if the variability of the sample mean is this nasty expression, suppose I have independent data instead. How many independent data points is that actually equivalent to? So the effective sample size, that t effective there, that I'm pointing to, is the number of independent observations that leads to the same variability of the sample mean as my correlated data delivers. And it's just a way of thinking about, conceptualizing, how much data do I actually have when I look at 333 years of highly persistent data instead. And so I can graph that relationship. You see that when the autocorrelation of the data is 0, 33 years of data is actually 33 years of data. And that's good because I can average out a lot of noise. But as the autocorrelation of the data increases, the number of data points I actually have, or the amount of diversifying of noise I can actually do, diminishes. And so remember my magic 10 years. This gives me a signal to noise ratio of 1. Well, that kind of is a problem when the data that I'm looking at is correlated with a 0.8 to 0.9 correlation. So this picture, if you take it at its face value, and it's only meant to kind of start your thinking along this way, but if you take it at face value, this picture suggests that the macro time series that I showed you earlier are equivalent to roughly 3 to 5 observations, or 3 to 5 years worth of data, as opposed to 33 years of data. The rest is just redundant data due to autocorrelation. It's all the overlap in the data that kind of arises from autocorrelation. This is the best case scenario, because this assumes that the 33 years of data I start with are actually all coming from the same distribution, that I'm starting with good data. And now the question is how much independent data is that equivalent to. But some of you might remember from a previous talk, I gave at a similar event here, my discussion on structural breaks. A lot of these time series, and you saw it from Josh's pictures, a lot of these time series exhibit strong structural breaks over time. There's structural breaks in the early 2000s. We find a lot of structural breaks after the Great Recession. financial crisis period. Those are very clear changes in the data sets, which means that we didn't start out with 33 observations at all. We started out with maybe 10 years of data, which now is equivalent to probably less than one true observation. So with the last couple of minutes that I have left, wanted to just very quickly think about life as a small data quant, because what I've convinced myself is that we're not in a big data problem, we're in a small data problem instead. And so whenever I think of that, I got to reminisce and think back at my favorite econometrics professor, Arnold Zellner, who in 1971, that's when I was born, wrote the leading book in Bayesian econometrics at the time, kind of the first real introduction of Bayesian econometrics in financial time series. So he had this great acronym he called KISS, and whenever I think, I have his voice in the back of my head telling me to keep it simple, stupid. That's not actually what KISS stands for. KISS stands for keep it sophisticatedly simple, meaning if you don't have a lot of data, you can't go too crazy in the way in which you think about relationships because you don't have a lot of degrees of freedom. And so that's one of the lessons we get from Bayesian statistics. There's some other lessons from Bayesian statistics, which is that statistics is not a 0-1 decision. You don't actually have to reject or accept a hypothesis, which means you don't actually have to have enough data to reject a hypothesis. Statistics is a learning exercise. We learn from data, and oftentimes you can learn from just a little bit of data. We don't have to always have a lot of data. All inferences involve bias versus variance trade-offs. The classical statisticians kind of let us off on a wrong tangent by always arguing you got to focus on those unbiased estimators, your OLS regressions, your sample means, they're all least unbiased, least variable unbiased estimator. But Bayes actually says it's okay to have a bias because a small bias often gets us a lot of variance reduction and ultimately leads to better inferences. One of the best biases that I would argue we do in our business every day. One of the biases that we encounter the most is, just remember that picture I showed you with all those structural breaks? We go through the analysis of analyzing those time series. We conclude that there's lots of structural breaks. And then guess what we do? We use a whole data set anyway. We know that there are structural breaks in the data set, but we also realize that if we don't use the whole data set, there's no chance that we're ever going to find anything. And so we're going to introduce a bias into our analysis by using data set that's not all coming from the same distribution, but that's the lesser of the two evils relative to having no data at all to draw your inferences from. So the second point I wanted to make, and I'll do this quickly, is everyone has priors. So we might as well embrace them. And the way a prior looks is something like this. You start out your analysis expecting a certain outcome. So you think the relationship is going to look something like this red distribution. And then you go to the data, and you find that the data tells you that the relationship looks quite different. And ultimately, you agree on a compromise, which is, OK, so probably the relationship is something in between. But if you remember this picture from your statistics textbooks, it's drawn a little different. In a classic statistical textbook, the prior would be really wide and spread out, meaning you are going through this analysis not really having an opinion at all. The data part would be really spiked. The data is telling me a lot about the relationship, and then I find a compromise between the two. It doesn't have to be that way. You can start with a stronger prior, add a little bit of weak data to it, and you're still learning something, even if it's not a lot. So the final thing I'd add is add as much data as you can. Data doesn't necessarily mean longer time series. It means cross-validation from other markets. It means pseudo data. So when AQR backtests for 140 years, that's not really real data. It's pseudo data, but it's still informative about what the relationship is that we're looking at. Fake data. I think Ewan might talk about simulating data. That gives you some information. It's data. Alternative data sources, secondary hypotheses, and then ultimately, don't ever throw away data. You might downweight data, that's perfectly reasonable. The data that's not as reliable, but it's sacrilege in Bayes to ever throw away data. So let me conclude. I think macrofinance is a small data problem, not a big data one. As such, and if you agree with me, I think you should agree that being a small data problem, you want to deploy small data tools, not necessarily get so fascinated about large data tools. And obviously, you can still be a quant, otherwise I wouldn't be here. Don't forget what the data looks like. And this is what it looks like, unfortunately. Here's a fun golf-related fun fact. Do you think this is a kettle or a golf ball? Obviously, it's a kettle. Turns out this is one of the cute examples of tricks algorithms. So if you can flip one further, VGG19, for those of you who haven't played with these tools, is one of the leading sort of top 2 or 3 image recognition algorithms that comes out of Oxford. It's distributed through TensorFlow, which is one of the readily available machine learning AI toolboxes out there. It does a phenomenal job at that classic, like, is this a cat or is this a dog kind of AI problem? But it turns out it thinks with 39% chance that this is a golf ball. And it assigns a 0.4% chance that it's actually a tea kettle. Because what's happening in these ultra deep neural networks is they start losing focus of the shape of objects and start zeroing in even very tightly, closely into individual features. After all, they got to figure out whether it's a cat or a dog by the shape of the whiskers and things like that, and lose sight of the picture at times. So that is all I have.